welcome to Presima's Global REIT Review for the fourth quarter of 2022. My name is Marc-André Flageole, and I'll be joined today by my colleague and portfolio manager, Chris Blanchard. Global REITs have had a challenging year in terms of performance, but the fourth quarter saw an early sign of stabilization, with stocks staging a rebound. We continue to believe that at this point, many REITs have attractive fundamentals and valuation. In today's presentation, we will touch on the following key points. We will briefly look back at 2022. We will then discuss how REITs are currently positioned, and we will finally highlight some themes and predictions going into 2023. Starting with 2022, very briefly, the year saw a correction of most risk assets, with central banks turning hawkish in the face of higher inflation. Consequently, real estate debt got more expensive, and that slowed down transactions. In the last quarter, however, inflation seems to peak, and central banks are starting to signal a slower pace of tightening. This sparked, at least for now, a return of investors' appetite for risk. As you can see on slide 4, this market environment was not favorable for global REITs, as they've underperformed this year both general equities and bonds. Interestingly, taking North America as an example, comparing the performance of REITs to the latest valuation of real estate investments on the private side, the disconnect seems overwhelming. This potentially signals either a great opportunity in REITs, relative pain ahead for private funds, or a combination of both. Now, looking at sectoral REIT performance, we generally note that underperformers, such as industrial and residential, started 2022 with relatively low implied yields. In the face of rising rates, these low-yielding sectors were clearly not in favor. In our view, this creates an opportunity because fundamentals in these sectors remain very solid. Higher-yielding sectors such as lodging and retail, as you can see, fared much better. Now, looking at the disconnect between public and private real estate, we note that most sectors are trading at one of their cheapest valuation level of the last decade, potentially setting the stage for quite positive performance ahead. As such, taking US REITs, for example, and graphing the discount in public REITs and their one-year forward performance, we can see that discounted REITs have typically signaled a very good entry point for the asset class, with solidly positive performance for the following year. With that, I'll pass it to my colleague Chris for the rest of the update.
Thank you, Marc. Taking a look at some of the supporting factors for REITs in 2023, we first focus on the fundamentals, which we don't believe are broken. Major markets such as the US, the UK, and Hong Kong all have low leverage levels, which should help cushion the impact of rising interest rates this year. As we can see on the chart on the lower right, our FFO growth expectations have come in during the year, but remain in positive territory and will continue to support well-covered dividend yields, as we see on the lower left. With good fundamentals and depressed stock prices, we're not surprised that the year was active from an M&A perspective. Direct market transactions are an important valuation support for REITs, and as we can see, well-capitalized investors were active in 2022, taking public REITs private at a significant premium to their share prices, and in most cases at a premium to their underlying asset values. Over the next few slides, we'll look at a global outlook by sector and region. Starting firstly with North America, we generally believe that the asset values will remain stable, while earnings in several sectors should continue to tick higher. Leverage is not really a concern except in Canada. And combining fundamentals and valuation, we believe the outlook for storage, data centers, industrial, and multifamily all screen pretty attractive. So where are we looking for opportunities in 2023? Manufactured housing, which we believe will have strong pricing power. Towers, as growing data usage requires more infrastructure. Industrial, as current rents remain much higher than expiring rents, which in turn is driving NOI growth. And Canadian residential, as immigration and regulatory environment begins to improve. And areas where we're more cautious. Triple net, as higher costs of capital may put the brakes on external growth. Lodging, as tourist spend moderates and labor costs escalate. And finally, office, where the blue sky scenario of conversions into residential will be harder than expected. Turning to Asia and Europe, we can see that, like North America, our expectations are that asset values will remain generally stable, except in Australia and the UK markets, which have seen a more rapid increase in interest rates, thus driving cap rates higher and values lower. Earnings growth across both regions is expected to remain resilient due to a better macroeconomic scenario in Hong Kong and the benefits of rental indexation in Japan and Europe. Leverage is a mixed bag, with Singapore, Japan, and much of Europe flashing red, while Hong Kong, Australia, and the UK screen well. When we combine all these factors with current valuations, Hong Kong and UK stand out as our more positive regions. So what's hot and what's not? Hong Kong landlords and developers will benefit from relaxed COVID measures and the opening of the border with China. Industrial and logistic REITs in both Asia and Europe will remain strong and have good rental growth. Towers in Europe is a very similar story to our call in the US. And possibly more contrarian, we feel that the heavily leveraged and beaten down sectors in the Nordics and Germany may right-size their balance sheets through asset sales, possible dividend cuts, and new equity, which should be a longer-term net positive. Areas where we're more cautious, Singapore, which may experience a slowing earnings as financing costs rise. Retail in Australia and Europe, as a possible recession may weigh on consumers. European healthcare, where higher cost of capital will slow external growth. And European offices, which will face an increasing capex bill to meet regulatory and tenant sustainability targets. To sum it all up, with our predictions for 2023, we believe that central bank tightening will finally cool the global economy. We think inflation slows, financing spreads will stabilize and possibly come in, and as a result, real estate transaction volumes should trend up. Industrial leasing markets, we believe, will continue to remain strong despite the economic slowdown. Luxury leisure travel will take a breather. Offices will continue to be tough, but the transaction market will thaw, allowing REITs to find a bottom. And finally, an active M&A market will show once again that REIT values have overshot to the downside. Thank you for listening, and we look forward to being in touch.